Tonight, you open your trading app, you check the green numbers, you feel for a second like you understand something everyone else missed. But the real answer is far stranger. You aren't competing against a machine, you're competing against millions of people trying the exact same thing at the exact same moment. Almost none of them win. Why? In 1965, economist Eugene Fama studied decades of stock prices at the University of Chicago. He found that prices moved almost randomly because they already reflected everything publicly known. The moment new information appeared, the price adjusted, often in minutes. He called it the efficient market hypothesis. If information is available to you, it's also available to a hedge fund with faster computers and more money. You're not late by hours, you're late by microseconds. So maybe skill matters more than information. In 1973, Princeton economist Burton Malkiel tested that idea in his book, A Random Walk Down Wall Street. His claim was almost insulting. A blindfolded monkey throwing darts at a newspaper's stock listings could perform about as well as a professional. Decades of data backed him up. S&P Dow Jones. Indices has tracked this for years, and the results repeat constantly. Roughly 80 to 90% of actively managed funds fail to beat a simple market index over 10 years. Not most years, almost every year. That should stop you. These are people with elite finance degrees, expensive research teams, and careers built entirely on picking winners. Most still lose to a fund that does nothing except hold everything, quarter after quarter, year after year. In 1976, Jack Bogle, founder of Vanguard, launched the first index fund for ordinary investors. Wall Street mocked it, calling it Bogle's folly. It had no manager, no strategy, just ownership of the whole market, left alone. Bogle admitted what the industry wouldn't. If almost nobody beats the market, trying to beat it is usually a losing bet once you count the fees. Index funds now hold trillions, because doing nothing patiently beat doing something aggressively. But if the market's this hard to beat, why does it feel so easy sometimes? Why do you remember the stock that doubled, but not the ones that quietly lost money? Psychologists Daniel Kahneman and Amos Tversky studied how people actually make decisions about money. Work later recognized with a Nobel Prize. They found people are irrational in consistent, predictable ways. Losing money hurts roughly twice as much as gaining the same amount feels good. That imbalance makes you sell winners too early and hold losers too long. Decisions driven by discomfort, not value. There's also survivorship bias, and it might be the most dangerous illusion of all. You hear about the person who bought the right stock and made a fortune. You don't hear about the 1,000 people who made the same bet and quietly lost everything because losers don't write memoirs. Visible winners create the illusion that winning is common. It isn't. You're seeing the tip of an iceberg made almost entirely of forgotten failures. Does anyone beat the market? Sure, Warren Buffett has for decades. But notice the shape of that fact. One name, repeated, in an industry with tens of thousands of participants. With that many people trying, a few extreme outliers should exist by chance alone, the way someone eventually flips heads 20 times in a row. Fund managers who beat the market one year overwhelmingly fail to repeat it the next. That looks less like skill and more like noise, sorted afterward into a story about genius. Here's the twist. The financial industry doesn't necessarily want you to know this. Trading generates fees. Active funds charge more than index funds. An entire industry profits from you believing the market is beatable. Now think about your phone. Trading apps use the same techniques as slot machines. Confetti animations, push notifications nudging you to react. Frequent trading is one of the most reliable ways to underperform the market. Yet, the design rewards it. The Securities and Exchange Commission has raised concerns about exactly this kind of gamified design, encouraging impulsive trading. You aren't naive for wanting to beat the market. You're human, inside a system built to exploit exactly the instincts you have. That isn't a personal failure. It's a predictable response to a well-designed trap. So what actually works? Not prediction, not timing. Time. Investing broadly, holding patiently, and ignoring daily noise has, historically, outperformed almost every attempt to outsmart the system. It won't make a good story at dinner, but the data keeps confirming it. Tonight, you'll open your trading app again. You'll check the numbers, and maybe, this time, the real answer isn't stranger than you thought. Maybe it's simpler and far harder to accept.